Hello, I'm going to talk about two news flashes that came up yesterday. The Indian foreign exchange kitty or the forex reserves grew to 700 billion yesterday. On the other hand, the FIIs sold about 12,000 crores in the stock market. In the last 3-4 days, they've probably sold about 25,000 crores. Now, if the forex reserves $700 billion, where is this money? How is it that the reserves keep changing? How do FIIs sell or invest? How do they get the money? If they are in some foreign country, let's say US or Europe, and they deal in dollars, how do they invest in India where it's the rupee that's being dealt in? All of this is going to take us to a very fascinating market, which is the forex market. Hi, I'm Hairsh Thakkar. I have about 25 years of experience in capital markets and financial markets. Today, we are going to talk about a very interesting market, the foreign exchange market. Let's dive into the topic straight away and talk about the foreign exchange market. Here's the usual disclaimer. This training content and delivery is absolutely confidential and is the private property of Imarticus Learning. Today, we are going to learn about the forex market or the FX market. We'll talk about how is this market, how does it work? How do the currencies trade? What are really NDFs? And we'll take live examples of trades where NDF currencies are involved. And finally, we'll also talk about FX swaps. We'll of course cover swaps and exclusively as a separate item, and then talk about some of the cross-currency swaps and the forex swaps that are in play today. So let's get started. The foreign exchange market or the forex market or FX market, as it is very popularly called, is a decentralized marketplace. And I'll explain this in far detail as we go along. But when you talk about two currencies and if they're traded, obviously it's going to be between the two countries or between the two parties in those economies or in those countries and so on. So it's the largest and the most liquid financial market in the world, where parties and largely institutions, banks deal in foreign currencies and trade in currencies. The currencies are quoted in pairs because what happens usually, so let's say if I were to take an example of any other asset class, let's say equity or a bond. So I can say that a 10-year government bond is, let's say, $100. So what I'm doing is basically expressing the price of the bond in terms of a particular currency, right? Or if I say the price of a stock, let's say Tesla. So if I say the price of Tesla is, let's say, X in dollars, I'm basically expressing the value or the price of that particular asset class in terms of a currency. However, in the case of currency market, both are currencies, right? So one currency needs to be expressed in terms of the other, which is why we say that the prices are quoted in pairs. And as I mentioned earlier, this is the most liquid, largely traded market in the world. The estimated turnover or the value of the trades on a daily basis is almost about $7.2 trillion in a day. Imagine a situation where there are two currencies being traded across the world, right? And I'll give you a small example. If we are sitting here in India, if I talk about the Indian time zone, New Zealand, let's say, opens The sun rises in New Zealand. It's about 3:34 a.m. in India time, and New Zealand market opens, and that's where the forex market opens, trades, banks start to trade. And then as the sun rises, and we also say the forex market follows the sun, so as the sun rises in various countries, the markets keep opening. So it's New Zealand, it's Australia, it's Japan, Korea, and then Singapore, Hong Kong, and so on and so on. Indian market opens at the RBI opening hours, and then by the afternoon you have the European markets opening. London, Paris, all of these markets open about 1 p.m. India time, and I'm referring to the Indian time zone at this point. And as the day progresses and the day ends, you have the US markets opening at a time where the India time is roughly around 7:30 in the evening. And by the time the US closes, it's about 2ish, 3 a.m. in the morning, which means that the day ends as far as the US market is concerned, but it's about 3:30 again, and the New Zealand market's open. So it's a 24-hour market, if I may put it that way. It's a code-driven market. We will talk about in detail as far as what the code-driven markets are and how the codes are given. The currencies, as I mentioned, are traded in pairs. So it's one currency that's expressed in terms of the other, right? But the question arises, how do you really exchange the currencies? I mean, it's very easy if it's a tourism, let's say, where I'm, let's say, visiting US, then I can probably buy some dollars even as hard cash. But the large market that we're talking about is not really about cash. It's about bank transfers. So it's the banks that are involved in the actual exchange of currencies, and we'll talk about it. How does that happen? But it's largely an interbank market. And the reason why FX is traded, well, the largest pie as far as the reason is the speculation, of course. Then there is hedging and arbitration. Yeah. So what is a forex trade? When you buy a currency for any other currency, you're basically looking to buy a foreign currency, let's say. So if I want to buy dollars because maybe I'm traveling to US, I'm actually going to need foreign exchange dollars in hard cash. So I'm going to pay maybe rupees for it and procure dollars for it. So when you say FX buy, when you buy a forex, basically you are procuring the foreign currency for a domestic currency, and vice versa if it's the other way around, right? On the other hand, if it's a cross deal or a cross currency trade, basically sitting in India and being an Indian citizen, if I deal in Euro and USD, where I, let's say, buy dollars against Euro or vice versa, I'm actually doing a cross currency deal. We'll see this in more detail as we go along. So the forex market, as we've established, it's basically a trade that is where a currency is traded for the other. Currency is traded always in pairs: Euro USD, USD INR, USD JPY, which is the Japanese yen, and so on and so on. Question is, why do I always say USD JPY and not JPY USD? So here, the nomenclature or the most common way of expressing it is the foreign currency is expressed in terms of the other currency. So when I say the base currency is, let's say, dollars, I'm actually trying to express Japanese yen for one particular dollar, for $1, right? We always say that what is the price of, let's say, a vegetable or a fruit. So we say X rupees dozen. So what we're doing is, for that particular quantity, we are trying to put a price or express a price in terms of the currency. In terms of, let's say, the currency trade, it's the base currency and the quoted currency, right? So USD is the base currency and JPY is the quoted currency. Now, who are the market participants? So let me just kind of simplify this. Why do we need Forex, or why do we need to trade in Forex, right? I'll give you 3 different scenarios to explain this, and accordingly we'll establish who are the players or the participants. So the simplest form is, let's say, an individual who is traveling to a different country, right, will need, the local currency to be able to manage the expenses and so on. So let's say tourism, right? So if an individual is, going for a vacation to, let's say, US or Europe, then he will need euros or dollars to be able to spend there. So that's one reason why, the Forex trade is required, or he will need to sell rupees and procure euros or dollars to be able to manage those expenses. So that's one reason as such. The second scenario is where you have, let's say, an exporter or an importer, right? So India, let's say, imports crude oil, let's say from Saudi Arabia, right? Or you have, exporters and importers, dealing in various, commodities, or groceries, or garments, or machinery, and so on. So when they deal with importers or exporters of the other country and procure these goods, they will need to pay them in their local currency, which means, again, there has to be a trade in those 2 currencies. So that's scenario number 2. The third scenario is where a company decides to invest and set up, let's say, a plant or a factory, or come to a particular country to do business. So example, let's say if Apple is going to come to India, it's already in India, of course, it has its own plant. But as an example, if Apple or Tesla have or want to, establish a factory in India, they will need to obviously spend a lot of money, procuring land, building the factory, and so on, which means they'll need the local currency. But they have their currency as dollars, which means they need to procure the Indian rupees, which means they need to sell dollars and buy euros, INRs, right? So that's the third scenario where the Forex currency is required for capital purpose. All the other were largely operating expenses or business reasons as such. This is capital infusion. This is for the purpose of capital, which we also called as, if you might recall, FDI, foreign direct investment, the result of which, the currencies are traded. Now, who are the players? So to start from a perspective of volumes and the amount of trades or the value of trades and so on, because this is a market where there will be no physical notes or cash exchanged as such, obviously the banks will be the biggest players in this. So you have the central banks, the commercial banks, then of course the corporations, the corporates, the big companies, the large companies we mentioned as an example, Apple, Tesla, and so on. And then you have finally, the retail traders, speculators are also. Then we'll talk about this aspect as we go along. I have already talked about the structure as such. This is a 24 hours market, 5 days a week. So this is basically a market that is somewhere or the other there is a trade going on in some currency, and the market is as such largely divided into an interbank market where the banks basically trade, and then there is the other institutions or retails who are also participating in this market. What are the instruments, or how is Forex really traded? Well, a large part of the trades are where there is an immediate payment or a spot market as such. When I say immediate, it does not necessarily mean the same day. When I say spot, it can be up to 2 days, which means you trade today, but you settle on the second day. Now, from an instrument perspective, there's not much of a complexity here, because again, these are two currencies, so it's as simple as that, one currency exchanged for the other. The instrument as such differs from the perspective of settlement. When do I trade and when do I actually exchange the currency? Yes. So here it's either spot or we can say immediate, but not necessarily in dictionary terms immediate as such. But here it's the spot or sometime in future, and I'll use the word forward transaction here, which means trade today but settle later. What is later? Well, it's 3 days or more, as simple as that. So a spot is up to 2 days, or 2 days rather, and forward is 3 and more. Leverage basically means that you trade beyond certain limits. Certain positions are created by keeping a certain amount as, in the simplest terms, a deposit. Now, let me just step aside and give you an example to simplify this. If I were to take a position, and let's say I have a view that the rupee will further weaken, as an example. So let's say the rupee is 83 rupees against a dollar, and I believe that the dollar is going to be more strong, the rupee is going to get more weaker. When I say strong and weak, what I'm saying is that the value of rupee will weaken, which means I have to give more rupees to buy the same dollar. So if dollar or $1 equals to 83 rupees, and if rupee weakens, which means the value of rupee is further going down, I'll have to give more rupees to buy the same dollar, which means 83 becomes 84, 85 and so on. Now, that's a view that I have, which means that if I were to buy a dollar today at 83 and spend 83 rupees, of course, with the view that, okay, I can sell this dollar maybe 2 days, maybe 10 days later at 84 or 85, I stand to gain a rupee or two. And that's the purpose why I bought the dollar. The purpose of buying the dollar was not really to spend dollars in US or so on. So this is purely speculation, right? I'm speculating that the rupee will weaken, the value of rupee will go from 83 to 84, and I will stand to gain if I have dollars today. Question is, how many dollars can I buy? Or if do I need to pay 83 rupees to buy dollar, and if I have to, let's say, buy $100, I will have to pay 8,300 rupees as such. But here is where leverage comes into play. The broking houses or the banks where they allow me to trade on this, or exchanges for that matter, they will take only, because I need to create this position. I don't really need dollars as such, but I just want to trade and keep this view for, let's say, a fortnight. So if based on historical data, let's say, if the maximum loss or probable loss for that matter is a rupee or two as such, I can actually keep a deposit and take more position or a bigger position or buy more dollars with that same amount of money, and that's leverage, right? So I don't have to. In other case, it was a trade where I actually need to buy dollars. I'll have to pay 83 rupees. But in leverage, I may just have to keep 10 rupees or 15 rupees or 20 rupees. And this depends on exchange, brokers, and so on, so many factors. I can actually take position, and the position is more than $1. So with just about 15, 20 rupees, I can actually buy 10, 20, $30 as such, because this leverage position gives me that facility. Yeah. Which means that I can, if I go right as far as my view was concerned, if I was correct in terms of the fact that the rupee may weaken, then I'll stand to make money, of course. Well, of course, if I'm wrong about it, then I stand to lose as well. Finally, regulation. So, given the fact that this is a decentralized market, it's a trade that's happening between two currencies. So two respective economies, two respective central banks come into play. Any country, as far as the money is concerned, the currency is concerned, the money supply is concerned, it's the central bank of that particular economy or country that governs the currency as such. Which means that if there has to be a forex trade, if that currency is to be traded, the central bank will be the single important regulatory body to manage the fluctuations or manage the currency as such, or the trades as such. Apart from this, of course, given now there are many exchanges where the currencies are traded, again the local commodities exchanges or commodities regulators will also come into play. So the regulation is largely the central banks and then the regulatory bodies which govern the commodities trade in respective countries. Here's the list of the acronyms as such, and some examples in terms of the currencies that are being traded. The ones that are marked in red are the ones that are the most heavily traded currency. So if I say that the approximate number of trades or the value of trades is about 7 trillion per day, which are these currencies that constitute the major part? So while there are 190 plus countries in the world and an equal number of currencies and so on, the most heavily traded currencies are these 8 currencies which are marked here in red, which is the Australian dollars, the Canadian dollars, the Swiss franc, the euro, the UK pounds, and so on. These 8 currencies constitute more than 92% of the trades on a given day. So that's information. The quotes we've already talked about, but let me dig a little deeper in terms of the expression of the quote or the way the quotes are really given. Currencies are traded, in terms of up to the 4th decimal. If in fact the quotes that you see can even go up to 8 decimals, but largely the trades that take place are up to the 4th decimal. There are some exceptions, of course, the Japanese currency, which is up to 2nd decimal and so on. The quote, the euro, let's say the euro USD, so it's for 1 euro, because euro being the stronger currency, the base currency, the USD being the quoted currency. Let's say the price, and for the sake of example here, is 1.1145. But the currency cannot be bought at the same price and sold at the same price, which means that there's no spread as such. This spread or this difference in the quotes is expressed in terms of pips, which is basically a change in the 1 decimal point or the 4th decimal point, right? So this is how the forex quotes are expressed as such. So we've been talking about the forex rate in terms of the base currency, or the price of the foreign currency in terms of the base currency. How does this price come up? How is this price decided? Well, there are two mechanisms really. One is the fixed rate and the other one is the floating rate. You will hear this term very often: oh, the currency is pegged to a dollar. The currency is pegged to a basket of currency, or it's pegged to gold, let's say. So basically, in case of a fixed exchange rate as such, the currency of a particular country is linked to a particular another currency or a basket of currencies, basically, and it's fixed. So there's not much of movement. The idea is to avoid fluctuations. For example, the UAE dirhams is pegged to the dollar. So you will always see that the dollar price or the dirhams as such don't really move very volatile way as far as the dollar price is concerned, or in terms of dollars is concerned. Same way the Hong Kong dollar as well. So in a fixed rate mechanism, the foreign currency is basically pegged to a particular value, to a particular currency or an exchange, or a basket of currencies as such. Yeah. Now, when you have a fixed rate, there are of course advantages and disadvantages. The major advantage being that the fixed rate allows certain traders, exporters, importers to know what the prices are going to be. So they are aware of the cash flows, and they are not subject to any exchange rate fluctuations as such. On the other hand, floating rate, and as the term itself suggests, the rate is floating, as in it keeps moving. So the value of the currency is allowed to fluctuate in response to the other changes in the other exchange rates and the forex market as such. The idea is because there are different trends, there are fluctuations, markets are moving, the floating rate adjusts or allows the currency to adjust according to the changing scenarios as such. Again, because these prices adjust automatically, they kind of allow a particular economy to kind of insulate themselves a little bit, or take on the impacts of certain shocks or economic events which could have a major impact on the local economy and so on. Most of the industrialized nations, they actually have a floating exchange rate since the 1970s, the early 1970s. In fact, you can also look up, there used to be a gold standard, or it was called as the Bretton Woods agreement, wherein 44 nations came up and they came up with an agreement where they would peg the local currencies, and there was a mechanism, but all of this was kind of abolished, so to say, somewhere in the early 70s. I believe it was 71 or 72, I'm not too sure. Let's talk about the quotes as such, and let's get to the trading aspect of this. The first thing is to understand really a quote. Now, we started the discussion saying this is a decentralized global market, which means a currency pair is traded, one currency in exchange for the other. So here is where we need someone to do market making, to create that market. Yeah. So the currency is quoted in pairs. So if I say that a euro USD, so for 1 euro, the dollar equivalent is, let's say, 1.12. Yeah. Now, what is the price to buy a USD or to sell a USD? Which means, or let's say, let's take the context of this example. It's right there on the screen as well. You have a euro USD trade where 1 euro equals to $1.12. But the question is, am I buying the euro or am I selling the euro? Let's talk in terms of euro here. If I am, let's say, trying to create a market. Now, if we were to have a market, we'll need buyers and sellers. The question is, how will the buyers find out a seller and vice versa? So here's where the market makers come into play. Market makers is the one who is going to act as a buyer to the seller and seller to the buyer. So he's the one who will say, okay, I'm going to give you a quote for, let's say, euro USD. If the going rate for 1 euro is 1.12 USD, and if the market maker is buying euro at 1.12 and selling euro at 1.12, then there is no profit or loss for him. Why is he into this business, right? Because he's obviously in this business to make money, which means the two quotes, that is the rate at which he will buy euros and the rate at which he will sell euros, has to be different. This is what is depicted here. So the euro USD two-way quote that a market maker will quote, and for the sake of example I have put it here, is 1.12 and 1.1205, which means the 0.0005 is the difference, and that is the spread. A spread is nothing but the ask price minus the bid price, or the sell price minus the buy price. Basically, when let's take a scenario. Let's say if I were to meet a market maker and ask him, what is the price of euro USD? Now here, I am not expressing whether I want to buy euros or I want to sell euros. I am simply asking, what is the price of euro USD? Market maker does not know my intention. So the market maker gives me a quote, 1.12, 1.1205, which means that it's from his perspective. He is saying that he will buy euros at 1.12, which means I will sell. If he's the buyer, I'm the seller. So he will buy at 1.12 and he will sell for 1.1205. So he's bought it for low and sold it for high. 0.0005 being the difference, that's his profit. That's why he's into this business. That's the spread we are talking about. I hope we've understood this particular quote very well. Now, the quote again can be expressed in two ways, the direct quote or the indirect quote. Let me again give you an example. If the currency that we talked about, and here there are two currencies, we've already established one expressed in terms of the other, right? So I can say that for $1, the money or the INR equivalent is 84 rupees. which means I'm saying that for $1 to be bought or sold, the price is 84 rupees. Or in other terms, we can say how many dollars can we buy for, let's say, 100 rupees. And if you get the quote and if you divide it, you can get it that way. It's 84, 100 divided by 84, it'll be 1.15, whatever in decimal terms, right? But what I'm trying to establish here is the direct quote, which means the base currency, the stronger currency, is expressed first. And to say that it's USD INR 84 rupees, which means $1, 84 rupees. So USD INR, where the stronger currency is expressed first or it's written first, is nothing but your direct quote. Now, in terms of the indirect quote, and as the words are suggesting here itself, it's the quoted currency that's expressed first or written first. To say, if in our earlier example we said USD INR 84 rupees, in this case, in indirect quote, we will have INR USD, right? Which is to say that if it's, let's say, 100 rupees or 1000 rupees, what will be the dollar equivalent for it? That's nothing but indirect quote. Here's a sample forex trade, and I've taken a screenshot of a particular system which shows certain components of that particular trade, and I will talk about this as we go along. And what is important is the way the components are expressed. There you see the trade date, the rate, the amount, the currency pair, which means which are the two currencies that are involved. And there is something also called as the spot, forward and swap down below. We'll talk about this in more detail as we go along. Who are the participants? We've talked about certain participants when we establish the reason for why people trade. It's the importers, exporters that trade. It's the capital, infusion or foreign direct investments. So who are the major participants in the forex markets? Well, first and foremost is the market maker as such. Yeah, the one who is really creating a market. Now, market maker as such, are nothing but those, given the size of the market and given the nature of the market, the global banks are largely the market makers. So you have these global banks who decide to give a two-way quote in certain currencies that they wish to do market making in. But market makers are the ones that provide liquidity to the forex market. When I say liquidity, they're the ones who are creating the market. So if, let's say, as an exporter, I want to buy Japanese yen, so instead of trying to look for someone who is willing to sell yen, I'd rather go to a market maker, and he's the one who's going to give me a quote, a two-way quote, and that's where I can deal in, let's say, Japanese yen. So market makers, very important participants. Then you have these commercial banks and investment banks, the ones who are really trading. Commercial banks largely come into play because they are the ones who are representing the importers, exporters. They are the ones who are facilitating trades between two countries, and trade finance is a huge business world over. And of course, the forex element or the currency element, the trade element is why commercial banks play a very important role. Investment banks, I've already talked about it. They're the ones who are often the serving as the market makers. They're the ones who are providing liquidity to forex trades. Hedge funds, again, very big players. Hedge funds are the ones who are basically investing in various countries, various economies, various asset classes, and they need to hedge their risk, which is why they again need to trade in forex to be able to hedge their positions, and that's depending on various strategies, but they are again major players as far as the forex market is concerned. Then you have the corporations, large corporates, companies that are exporting, importing their goods and services. So they're the ones who are required to, let's say, deal in forex. For example, and I'll take a very simple example. If there is a car manufacturer, let's say here in India, and let's say the car manufacturer has exported certain SUVs or cars to, let's say, a country in Europe or in Africa or in Southeast Asia, the money that will come to them, because the importing country or the importer as such will pay in local currency, but they ultimately need to bring in that currency here in India, which means again the need for doing a forex trade. So again, corporations, big players as far as forex trades are concerned. Then you have the brokerage firms. These are the ones that are basically allowing or giving access to retail and institutional clients if they wish to deal in forex for whatever reason. Could be speculation, could be genuine currency needs, and so on. But again, brokerage firms, simply the ones who are allowing and giving trading and execution services. Then you have the government and the government or the sovereign wealth funds. Basically, governments also deal in foreign currency. Apart from certain other reasons, be it investments and sovereign wealth fund reasons, but governments and through the central banks basically trade in the currency, largely to regulate or to monitor and take corrective steps as far as their local currency is concerned. So you would have read it in newspapers or channels that the RBI steps in. RBI bought rupees, or RBI sold rupees, or bought dollars, and so on. So basically to monitor, manage the currency fluctuations, the central banks of a particular country also deal in forex trade. Then you have the retail traders, and speculation being a very big reason for that. So as an individual, if I have a view that the rupee will weaken or rupee will become stronger, based on that I would like to make money out of this view, then I have to trade, and for which I will have to again participate in the forex market. So these are the participants who are dealing in the forex markets on a day-to-day basis. Now let's talk about what are the factors that affect the forex rates. Why do currency rates change or fluctuate? Here are some of the reasons that affect and bring about fluctuation or volatility in forex rate. Well, first one, interest rates. Let me give you an example to simplify this. If, let's say, the interest rates in, let's say, India is 7%, and in Japan, let's say it's 0.5%, or in US it's, and I'm just making this up, it's let's say 2% or 3%. Certain countries, because the interest rates is high, they provide a good investment opportunity, which means if I have $1 million, if I put that $1 million into a bank and get interest in US, I'll probably make 2% or 3%. But if the same money I invest in India, I'll make 7%. Well, of course, there are many other factors, and I'm not suggesting it's that simple to be able to do that. But just for the sake of this example and the factor affecting the forex rate, the interest rates matter a lot as far as two different countries are concerned. And it's the respective interest rates that have an impact on the currency rates as such. There is a term called as interest rate parity, which means the forex rates are adjusted to be able to match the interest rates of two respective countries. Second is your inflation rate. So countries with lower inflation means that the purchasing power of that particular economy is very good. The currency commands, it's a stronger currency. The currency is strong enough to be able to buy goods and services because the inflation is low, and so on. So inflation rates, if lower, which means that the currency can get stronger, and of course vice versa. Certain economic indicators, so basically a currency pegged or expressed rather in terms of the other currency, the value of that currency depends on how the inherent economy is doing. If the inherent economy is doing well in terms of GDP, in terms of trade balances, if there are more exports, less imports, dependence on other countries is less, a very self-sufficient kind of economy, obviously the currency is going to be stronger. So that's again a factor that impacts the currency rates. Then it's the political stability. Today we are seeing a lot of examples where there is political instability, countries have gone to wars. So obviously that impacts the economy and in turn the currency of that particular economy. If you have a country that's politically stable, there are no turmoils, or there are no geopolitical issues, then obviously the currency is going to be far stable and even stronger for that matter. Then you have the market sentiment, and I'll cover supply and demand and market sentiment together. So basically, if the market is of the opinion that there could be a factor, there could be a news, or there could be an event, or there could be an eventuality which can lead to weakening of a particular currency, then obviously there'll be a fluctuation in the currency price. So market sentiment is largely short term. So it's maybe a week, maybe a day, maybe a few hours, maybe a few weeks, and so on, right? And depending on the market sentiment, it will lead to a demand and supply imbalance as such. Either there'll be a high demand or there'll be a high supply, which will lead to the fact that the currency either will go up or go down, will become stronger or will become weaker in relation to the other currency. So the market sentiment and the supply demand are the factors that again impact the forex rate to a large extent. Then you have the central bank intervention, if I may put it that way. So we've talked about the fact that the central bank intervenes to manage and maintain the currency. At times, is buying the local currency or buying the dollars or selling the local currency. The idea is to maintain those exchange rates, and it's in line with the overall monetary policy of that particular current country. So the central bank actions is again going to have a change in or impact as far as the forex rates is concerned. Speculation. Well, this is one of the factors that causes a lot of fluctuations, a change in the price owing to the speculative aspect. A large part of the trades on any given day are speculative in nature, right? So much so that if I make a statement that maybe 80-85% or 90% of the trades are largely speculation. I may not be wrong. So a high degree of speculation will obviously lead to a lot of change as far as the currency rates are concerned. Then you have certain market interventions. So be it the governments, be it the central banks, in order to kind of stabilize the country's currency value, will take certain trades or steps to stabilize the currency, which of course will lead to a change as far as the currency values are concerned, or will affect the forex rates. Then you have the global events. Well, any natural disasters, geopolitical situations lead to a lot of fluctuations or volatility in the currency markets. To give you an example, if there are two nations at war, which can have an impact, let's say, on the prices of crude oil, which means that that will impact crude being a very important element of a country's trades and balance payments and so on, will lead to the fact that the currency rates will fluctuate because there is a global event, there is a political instability, and so on and so on. So because in the area of globalization, all markets are kind of connected and there are ripple effects. If there is one event and one market is impacted, it will lead to an impact to the other markets as well. Trade balance, well, it's basically the net of your exports versus imports, whether it's a surplus, a trade surplus, or a trade deficit, that will make a currency stronger or a weaker, as the case may be. And finally, in terms of liquidity, we've talked about this, that you have 8 currencies that are highly liquid and the most traded ones. Now I'll give you an example to substantiate this point. So if you have a trade like a Euro USD or a USD Japanese yen, very easily traded, highly liquid market, many market makers. Now, if there are many market makers dealing in USD JPY, the spread, which means the difference between the bid and the ask, will be very less. In comparison, if there is any other not so easily traded currency, let's say Danish kroner or Turkish lira or any other Mexican pesos and so on, these are currencies that are not very liquid, and I'm giving this as an example. Then obviously there will be less liquidity, which means it's difficult for a market maker to find a seller or find a buyer depending on the first leg of the trade. So given that it's not easy, or the currency is not very liquid, the spread is going to be higher. So if USD JPY had a very minimal spread which went up to 4th, 5th, or even 6th decimal, you may have certain currencies where the liquidity is not very high, which means the spreads are maybe up to just about 1st or the 2nd decimal or 3rd decimal for that matter. So this is why, depending on the market liquidity, whether the currency is liquid or not, that can have an impact on the prices, the rates, and the volatility or the fluctuations in those forex rates. Now let's talk about a trade. We'll take an example to substantiate this further. Why do people trade, or why are forex trades done? Here are the four main reasons, and we'll dwell into these in detail. First one is the capital repatriation. We've talked about a very important reason to invest in a particular country, bring in capital by route of the maybe a foreign direct investment, FDI, and so on. Now, if a particular corporation decides to go back to their country and do not wish to continue, then obviously they will want to take back their capital, which is nothing but your capital repatriation as such. Hedging. Now, let me give you an example here. If there is an exporter who's, let's say, exporting SUVs to a particular country, and the payment or the payment against these SUVs will be received 3 months in hence, which is 3 months in future. These 3 months pose a risk, right? So if, depending on the currency weakening or getting stronger, the cash flows or the revenue that is generated out of these sale of SUVs will get impacted, which means that if the currency, depending on the trade, of course, will weaken or get stronger, there'll be a loss or profit. But what is important is to mitigate against this loss. The corporation as such is into the business of manufacturing and exporting SUVs and not in the business of speculating or trading and profiting from the currency fluctuations. So what it likes to do is to mitigate that risk against a potential loss, which is the reason they will trade and they will take a hedge trade. Arbitrage. Well, arbitrage is, in the most simplest way of understanding, is to take advantage of price differences between two asset classes or two markets for that matter. Not asset classes, it'll the markets basically. So if, let us say, and I'll just make it up for the sake of example, if a dollar versus INR versus a dollar versus JPY, yeah, you have a rate. So if USD INR is 83 and USD JPY, let's say, is 130, one has to look at the rate between these currencies, which is INR and JPY. And if it's not mathematically the same, for whatever demand supply, the price of a JPY INR or an INR JPY may not be mathematically the same, which means there is a possibility or a potential opportunity, which is nothing but your arbitrage. This is in context of the currency markets. Speculating, well, we've already established this. If there is a view that a currency can get stronger or weaker depending on an event or demand supply or any other factor, then there could be a reason to trade and try and make money out of it. Let's get into details of each of this and understand them in far more detail. So the first one is capital repatriation. Now, once a fund manager decides to exit out of a global investment, now, and we've seen it in recent reports that the FIs are selling and they're selling equities. So what they're doing basically is the investment they made in the equity market, they are selling. Now, if they sell the equity shares, they get money in rupees, but they need to repatriate these funds back to US or any other economy that they are registered in or the fund is from. Then they also need to do a forex trade, because they got the money in rupees, but they want it in dollars or euros or pounds or any other currency for that matter. They need to also sell these rupees and buy the respective currency, which means there has to be a forex trade. For every equity trade done by a foreign institution, there has to be a corresponding FX trade as well if they have to repatriate these funds. Hedging, we've already talked about it. Depending on the exporters, importers, there can be a position where the position is subject to certain economic loss purely due to a currency fluctuation. And in order to mitigate that, the hedging trade is taken. Now, what could be those trades? How to hedge? We'll talk about it as we go along. But hedging is basically a process where you take a contra trade or you take a trade to mitigate the risk of a particular currency fluctuation. Arbitrage, as I said, it's basically three currencies involved, and in this case we've taken an example of let's say a GBP euro trade. Again, two different markets. The price of a GBP euro in one market vis-a-vis the other is not the same, which means it provides for an opportunity where you can play on the price difference as such and make money. Let me make a statement here. The arbitrage opportunities are very short-lived because, and I'd read it somewhere that the arbitrage is like a $100 bill that's lying on the road. It's just waiting to be picked up, right? And the opportunity is there. Moment somebody will spot it, will do a contra trade, will do a trade accordingly, and which will mean that the prices will correct itself, or the arbitrage opportunity will cease to exist simply because certain trades have taken place in order to make the most out of these arbitrage opportunities. So arbitrage opportunities keep happening because of the imbalance between demand and supply in two different markets. You can't always have the two markets going exactly in tandem, or the demand supply will create that change in price, which means that there will always be an opportunity, but at the same time those opportunities are always waiting to be picked up, which means that there will be trades, arbitrage trades that are taken, and the people will try to make money out of it. Speculation, well, that's the single big reason for a lot of trades that take place. In fact, bulk of the trades that take place in the global markets are due to speculation. So here's an example again where we've taken a Euro USD trade with the idea that there is a view that the rate of euro may weaken or get stronger, which means that basis that view, a trade can be taken in order to make a profit. So what is global investing? Basically, when a fund, let's say a US fund, a mutual fund or a hedge fund, is going to invest, let's say in India or China or Brazil or any of the other markets, then it will have to convert or sell US dollars and buy the local currency to be able to invest in that respective country. So that's global investing. And for this, let's try and now understand Forex trades and the types of trades. So here are the trades as far as Forex particularly is concerned. I can classify them into largely two. One is your cash trades and the other is your derivative trades. And then this is very similar to any other asset class as such. If you buy equities and you pay for it and you take delivery, then that's nothing but your cash trade or your spot trade as such. And if you buy a futures or an options in equities, that's your derivative trade. Similarly, as far as FX or Forex trades are concerned, there are cash trades and then there are derivative trades. Let me explain these in detail. So FX cash trade, and here the classification is basically on the on settlement as such. So it's the differentiation is based on when is it settled. Yeah. FX cash, a cash trade is when the settlement takes on the same place. So the FX cash is basically a trade where the settlement takes place on the same date, right? So here your trade date is equal to the settlement date, and in Forex we very popularly, commonly rather, refer settlement date as value date. So when the trade date is the same as the value date, or the value date and trade date are same, then that's your cash trade. So when your value date is the same as the trade date, that's your cash trade. Tom refers to the word tomorrow as such. So when the value date or the settlement date is the next business day from the trade day, then that's your Tom trade. So please note that it's the business day that we are referring here. All right. So if a trade is done on a Friday, and it will be settled on Monday, not on a Saturday and Sunday. So FX Tom basically means the value date is one day later than the trade date. So it's basically trade date plus 1. Yeah, the value date is trade date plus 1 business day. Spot is 2 days. So if the trade date is, let's say, 5th of October or 7th of October, I've not really looked at the calendar whether it's a Monday or a Tuesday or a business day, but just making it up. If the trade date is, let's say, 7th of October, then the spot trade, which is T plus 2, will mean 9th of October. That's when the trade will get settled. So that's as far as the cash trades or spot trades are concerned. Derivative trades means that the trade is agreed today, but is settled in future. Now, given that the Forex is a decentralized market, there are forward trades, not futures trades. Well, there can be FX futures as well, depending on the exchange. If exchange comes up with a standardized Forex trade, even there can be FX futures. But for the purpose of our discussion today, we'll restrict it to forwards, which means that if a trade is done on a date, and if the settlement happens 3 days hence, 3 days or more, then that's your forward trade. Options, these are your forward or Forex options as such. Basically, you get a right to buy a Forex or the right to sell, depending on the construct of the trade. But basically, these are option trades on the Forex currency or on the Forex as such. Swaps, we'll discuss this in detail as such, but nothing but two currencies or two interest rates or two notionals are exchanged. That's nothing but your FX swaps. What are the components of a Forex trade? So basically you need, if you were to book a Forex trade, if you were to execute a trade, you need these details in order to have complete understanding of what the trade is all about. Well, first and foremost is the date on which the trade was agreed, which is your trade date. The value date is the date on which actually the funds are moving from one bank account to another account. So it's the settlement of the trade that was agreed on the trade date. Settlement date or value date, as it is commonly referred to. Then there have to be two currencies, right? Currencies are traded in pairs. It's one currency exchanged for the other. So definitely there have to be two currencies. One is, of course, the buy currency and the other one is the sell currency. Then the notional as such. Notional is nothing but the amount as such. So if it's, let's say, a USD INR trade at a rate of 83, and if it's 1 million USD on one side, and then taking the rate into consideration of 83, so it's 1 million USD and 83 million INR. So these are the actual amounts that will be bought and sold. So that's your notional. And then the rate. This is important because what's the rate at which this actual trade has taken place? So that's the exchange rate. Direction is basically whether it's bought or sold. So for one party, it's going to be buying a particular currency, and similarly for the other party, it will be the sell, the same currency. So direction is basically the buying and selling, or the bought and sold part of it. Counterparty, these are the parties that are involved in the trade. One is buying a currency and the other one is selling the currency. So it's the counterparties as such. Standard settlement instructions, or SSI, is very commonly used in operations, is basically your bank account details, right? The parties have to tell each other where they would like to have their dollars or INRs or JPY or their currencies that they've bought being delivered at. So it's the settlement instructions in terms of bank account details and so on and so on. We have mentioned here nostro and vostro, and let's talk about nostros and vostros. What is a nostro account? So a nostro is basically an account. It's, let's say, an account held in a foreign country in that particular local currency with a particular local bank. So it's basically, if I were to give an example, if I have an account in the US, in dollars, in New York with a local bank, then for me, that account is my nostro, right? So if I have a dollar account in US with, let's say, a JP Morgan Chase, then that's basically my nostro account. Vostro is basically the same account, but it's the perspective which is different here. So my account for me is my nostro, but my account for the bank is a vostro. So it's basically my account or our account versus your account. It's just the point of view that's changing here. But this is a very commonly used term, nostro and vostro. How is it traded? Well, there are many electronic methods as such. It's the EBS or the Reuters, where basically you have these quotes coming up from various market makers, and banks also have their own systems where they publish these rates, and based on the requirement, the parties can trade through these electronic trading systems. There are also, direct, connections between or communication lines between two banks or two market makers or two institutions where they trade with the market makers, and depending on their quotes and depending on negotiations and final agreement, the trades are executed. Now let's get to a very interesting part or topic when it comes to forex trading, which is non-deliverable forwards. If you look at this word non-deliverable forward, it tends to kind of explain its meaning, but let me explain this and simplify this for you. So there are certain currencies where there is a restricted movement. The governments of those economies, those countries, do not wish the currency to be very freely traded and so on. There are some restrictions by the central bank for whatever reasons, and we are not going to get there for the moment. But the bottom line is these currencies as such are non-deliverable. What do you mean by non-deliverable? Basically, when a trade takes place between two currencies, let's say a USD and a Japanese yen, on the settlement date, the currencies move from the seller's account to the buyer's account. In that country, currency does not leave the country, but it's the movement from one bank account to another bank account in that respective country. In case of non-deliverable forwards, however, there is a restriction. So if the problem is that one of the currency cannot move, how do you really settle a trade? Yeah. So the NDF, the non-deliverable forward, is a trade where the settlement takes place based on the current rate. It's cash settled, which means that the physical movement, and I don't mean literal here, the physical movement, the movement from one bank account to another bank account does not happen. Let me simplify this. Let me give you an example. Let's say if I were to sell this wristwatch, let's say for 50,000 rupees, and I, as per the trade agreement, have said that we trade today, but I will deliver this wristwatch after 7 days. On the 7th day, on the date of settlement, I'm supposed to be delivering this wristwatch. But on that day, I choose not to. Yeah, I'm just making up this example to simplify the concept as such. So on that day, I say, I do not wish to part with this wristwatch. So how do we settle the trade? So what I offer is that let's look at the current rate of this wristwatch, and let us say it's 52,000. So basically, I sold the watch for 50,000, and now the price is 52,000, and technically I want to buy it back because I don't want to part with the wristwatch. What I'm doing is comparing the sale price, which is 50,000, and the current price, which is 52,000, and I say, why don't I give the difference of 2,000 rupees to the buyer, and thereby I get to keep my watch, I don't have to part with it, and the trade is also settled. Very simple. Yeah. Same thing as far as non-deliverable forwards are concerned. So what we do here is, and it's written here very aptly, these are short-term cash settled forward trades, right? Cash settled. In financial markets, there are two concepts: physical settlement, cash settlement. Physical settlement is when you actually exchange the asset class, be it any of the asset class. And in cash settlement, it's basically the difference, the price difference. So the settlement takes place on the basis of the trade price versus the current price, and whatever the difference is, either parties will exchange that cash flow. So these are cash settled forward contracts, right? And these are obviously converted or settled rather in a fully convertible currency, because the NDF cannot move, but so it has to be settled in a fully convertible currency like a USD or a euro and so on. Profit and loss will obviously occur because there is a price difference between the date on which the trade was agreed and the date on which it's supposed to be settled. Whatever the difference be the price, there could be profit or loss, the parties will exchange the cash flows. How is it settled? Well, there is a mechanism for it, which is called as the fixing date and the settlement. We'll talk about that in a moment. And these are for forward contracts. So you typically have anywhere between a 1 month to a 1 year kind of a time period wherein these trades are agreed and then settled. And as I said, the settlement takes place in a fully convertible currency, which means these are most of the time settled in USD, and there can also be the British pound or the euros for that matter. Why are these popular? Corporates dealing with various economies, countries in terms of exports, imports, but the currency being not that liquid or is restricted, have to resort to such trades to be able to settle the trades against the hedging exposures or the risk mitigation strategies that they would have adopted. Let's take an example to understand the fixing date and the fixing rate as such. So if there is a long position created, when I say long, we mean buy. Basically, when the idea is to trade today and make an FX payment in future. Here we have taken the example of a USD INR trade. There are some currencies who are non-deliverable forwards, like the Turkish lira or the Mexican peso or the Korean won. The Indian rupee is also a non-deliverable forward as such. However, the Indian rupee as such, there is a part, I would say, non-deliverability. There is a mechanism where you can have rupee also deliverable. But for the sake of this discussion and our example, I'm taking an example where you have a USD INR trade for $75,000. And the rate is, let's say, 75. Yeah, example. Accordingly, on the settlement date, the trade has to be settled at the rate of 75. But because the NDF currency, which is INR, is not going to get delivered, will not be delivered, this trade has to be cash settled. This trade has to be settled in USD only. So now, as we had established in our example, the latest rate needs to be taken. The question comes, which rate to be taken? Now, obviously, both parties will have, a say, or will say a rate that is more favorable to them, because the rate is changing every minute. So there is a standard process or a standardization in terms of what rate to be taken, from which date, and so on. So the parties as such agree that in case of an NDF trade, we will take a particular rate of a particular date, which is called as the fixing date. Look at the word fixing. So the rate has to be fixed. So which rate? So the rate on that particular date. So the fixing date is pre-agreed, and the fixing rate is taken, the rate on which the settlement has to take place. And based on the comparison between the trade price and the fixing rate, whatever be the differential. And as we've already talked about it, there could be a profit or a loss. So either party will exchange the P&L or the difference as such. In this case, we've taken 79. So there is a rate increase of 4 rupees. Similarly, if there was a short position and it's the other way around, then it's the counterparty that will have to pay the 4 rupees as such. But basically, the concept as such is to cash settle the trade, and for that matter, a fixing date is taken into consideration. Again, this is pre-decided. It's a part of the contract as such, and on that day, the rate is taken into consideration and compared with the trade price as such, and whatever be the differential is either paid or received. So this is the concept of a non-deliverable forwards or NDF. Now let's get to a very interesting topic, forex swaps. This is the part of the derivative contracts. Before we get to understanding a forex swap or an FX swap, let's try and understand what is a swap. So as the word suggests, swap, basically an exchange, right? You are basically exchanging one thing for the other. That's a literal meaning of it. Swaps as such are a very popular asset class or a trade as such that is undertaken largely when there are two varying interest rates or there is a variation as far as the type of interest rate is concerned. Let me give you an example. So let's say there is a corporation that is paying a fixed interest rate to its, let's say, bondholders, right? Bondholders, as you're aware, are entitled to an interest and for a particular period of time, and let's say that's a fixed one. On the other hand, there is another corporation which is subject to again making interest rate payments, but these are dependent on the benchmark interest rates and hence they are floating rate as such. Now, both the corporations have a different viewpoint as far as the interest rates are concerned, or have their own set of problems, if I may put it that way. The first corporation, which is paying the fixed interest rate, believes that the interest rate in the near term can go down. In that case, it will be at a loss because it will still end up paying the fixed interest rate, whereas the market rates have come down. So, simply putting it in a simple manner, the corporation is paying fixed interest rate but would prefer floating interest rates. On the other hand, the corporation that is paying the floating rate interest, because the rates keep changing and there's fluctuation, is unable to really ascertain its cash flows and would prefer a fixed interest rate. What if these two corporations come together, talk to each other and say, why don't we swap these interest rate? One corporation which is paying fixed says, let me pay floating, and the other one says, let me pay fixed. Well, easier said than done, and I've made it very simple. I said there are many factors, the principal amount, and there are, regulations and so many other things. So this is only for the sake of simplifying what is a swap that I've taken this example. But basically, we are talking about swapping two cash flows here, and that's your interest rate swap. Now, bring this to the our discussion of Forex as such. In the earlier case, the point of contention or the discussion was the fixed versus floating. It's the type of interest rate. In our case, let's say Forex swap, we will say that here we are going to have a swap between a spot and a forward trade. So it's the element of time in between. And this is very logical, because if I am doing a trade today and I'm supposed to be receiving certain payments in future, that payment again is subject to interest rates and currency rates and so market fluctuations as such. Let me give you an example here. So if there is a corporation, let us say it's exporting, let's say, goods and expecting, let's say, $1 million after 3 months, right? So there is a trade here and there is $1 million that's coming up after 3 months. So there is a cash flow that is subject to, that's a receivable after 3 months, of course, which means this receivable is subject to the currency fluctuations. This money, depending on the exchange rate, can be 1 million plus or little less than 1 million, depending on the fluctuations that can take place in the currency rates. So what if there is a trade here, and there is one more reason that this money is coming after 3 months, which means the corporation cannot use this money and may want to use this or get the opportunity to use this money today. So what if this corporation says, why don't I do a trade where I'm going to basically buy the currency, the local currency, the currency which the $1 million is coming into, as a spot trade, and also simultaneously do a trade 3 months forward where I'm going to deliver this currency. So I have a cash flow that's coming up after 3 months, and if it coincides and should coincide with the forward trade date, I can take the money from here and I can deliver it. What it effectively means is that I've locked in the prices. Taking a spot trade and a forward trade, I have locked in both the prices, which means that the trade, the money that I was going to receive after 3 months, is no longer subject to any currency rate fluctuations. So this is nothing but a swap, because it's exchange of cash flows, and because there is one leg of it which is the spot and the other leg is the forward, hence there is a swap, because there is a difference in the time zone or times as such. So you have two legs in this trade, where I do a trade which is a spot trade, and let's say example, a Euro USD, where I buy euros and sell USD. Simultaneously, I do another trade which is the reverse of this trade, but this is 3 months forward. This is going to get settled 3 months hence, right? So there are two exchange rates, because obviously the rates for the spot, which is delivering in 2 days, versus the delivery after 3 months, will be different. So there will be two exchange rates, which is spot exchange rate and the forward exchange rates, which means that there is an element of course, a loss, because there will be some cost that I'm paying for being able to use the money today as against 3 months hence. Remember, money has value, right? So if I'm going to get a payment after 3 months and I'm doing a trade that's going to settle 3 months, I do have to bear the cost for waiting those 3 months, right? So that's what the difference is going to be between the spot exchange rate and the forward exchange rate. The value date is the maturity or the settlement date of the spot trade, which is your near leg. And the maturity date is basically the value date or the settlement and of the far leg, which is the forward leg as such, right? And in our example, we have taken 3 months, but it could be anything like days, months, weeks, and so on. We've already established that there is a difference between the two exchange rates, the spot and the forward. What is this based on? Well, this is based on the 3 months time difference that is there. And as I said, how do you quantify that? So money has value and interest rates of that particular economy decide the value of money. If I have to wait for 3 months, then I need to be compensated for those 3 months, which is nothing but the 3 months interest. So that's your interest rate differential. And finally, counterparties, we've already established that these are the two parties that are involved in this forex swap or FX swap. Yeah. All the other terms and conditions need to be agreed upon, and there are very standard conventions and applicable. So the industry comes up with these conventions from time to time, and based on those conventions in terms of, and I'll give you a simple example. If the 3-month date of settlement, let's say, happens to be a Sunday, so should we take Monday as the settlement date or should we take Friday, right? There are no right or wrong answers here, but there has to be an agreement. There has to be a convention around it, that what is the standard practice in such a case. So these are certain conventions, and in this case it's called as the business day convention. So these market conventions and industry standards are taken into consideration, and both the parties should and must adhere to these practices. And finally, regulations in place in terms of the standard regulations around that, compliances need to be there. The central banks and the parties kind of adhere to these regulatory compliances that the central bank mandates them for. So this is what an FX swap is. We've seen both the legs. Here are the trade economics of an FX swap. So there you see both the legs as such, the near leg, which is the leg 1, and the far leg or the forward leg or the leg 2. Basically, you have mostly all the components similar, except of course, the settlement date and the rates will differ. We've already taken an example in terms of FX swap. So one is a spot, the other one is a forward, and both are agreed on the trade date. It's just that the execution or the settlement takes place for the spot part of it, or the leg 1 part of it, T+2, and the forward leg will take place based on the number of days or the weeks that has been pre-agreed on. Yeah. So this is the step. Firstly, it will be the swap, the initial exchange, right? And based on the agreement, the final date on the maturity date, the second leg will be executed. So this is basically an FX swap.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.